good morning, everyone, and thanks for being on our inaugural public markets presentation. As this is the first occasion, I'm going to spend a few moments this morning introducing ActiveOps and a little bit about our proposition before we go into the actual full year results. And then after Paddy's talked through the details, I'll also come back around on our strategy, essentially following on from our IPO launch earlier this year, and give you an update on the outlook based on the first quarter's trading. In terms of the business, for those of you who haven't previously come across us, we're a SaaS enterprise software platform. We service banks, insurance companies, and BPOs or outsourcers that provision to that type of customer base. We are global, so we operate across the world in about 40 countries, primarily driven by the fact that our enterprise customers have staff and facilities in multiple locations. Our customer base includes organizations like AIA, Westpac, National Australia Bank in Asia Pacific, through to TD Bank, Anthem in the US, and more closer to home, where our customers in the banking sector in the UK would include Nationwide, Barclays, and a number of others. We have about 170 staff, and our customer base, is about 80 people, primarily selling direct, but we also do have increasing amounts of implementation partners who package and incorporate our products within their transformation program type activities. Just to give you a quick flavor of what we do, our product does, effectively it's a control system. It enables organizations with very large multiple units of work and capacity to be better in control of those things, which is obviously very relevant to the cost reduction agenda, the compliance agenda, and all sorts of challenges, let's say, with providing and securing a coherent service. Classically, as you see on the top there, organizations would have work and capacity, which meant their performance is quite variable because of the different types of unit and different types of work. And by using ActiveOps, organizations take our software, our enterprise platform, and it gives them control. And that provides the means by which, in using our embedded solution, they then, if you like, drive better value from that capacity. But I think in the context of COVID and the current environment, clearly, it gives them control. So it's the precision of control our software provides enables them to then exploit their robotic programs, their digital agendas, their dispersed resources, gives them the choices and the control over their operations to execute their strategy better. So that's a quick overview. I think the interesting thing from our point of view, and it starts to go into the results of the year, I can't imagine a context of anything which has brought the issues of controlling operations more clearly to focus than the COVID experience. If you can just imagine, essentially, all those organizations for whom many of the ways in which they've managed their capacity and their work in those back offices, suddenly, which had traditionally relied on working in designated places, suddenly had to disappear back up to their homes and their sitting rooms clutching laptops. And so it was a real wake-up call for a lot of organizations about how they did that. So whilst the problem is a well-established one, since Romans wrote playbooks for building roads to try and make performance more consistent, that the actual current recent context has really shown that issue of how to deliver scale and efficiency and control and well-being across these enterprises in a very particular way. Moving on then to a quick overview of our results for this year. I just think for ActiveOps, it's been an extraordinary year and an exceptional in many, many ways. I mean, firstly, the fundamentals of a SaaS recurrent revenue software business, I think, has served us very, very well. Our underlying SaaS revenue and all through that tremendous uncertainty of last year, when our clients really were in all sorts of places in terms of having to fulfill in the midst of the pandemic, that underlying heartbeat of a SaaS recurrent revenue business stood us incredibly well. On top of that and the underlying strength of that, I think what was particularly good for us in a second way was the way in which we were able to readjust our delivery mechanism, so that after the half year, the story of the year was definitely one of two halves. The first part of the year where people weren't able to get into their offices, they didn't want to implement, and you can imagine, how do we implement in a context where people are no longer in the same place? We were able to completely re-engineer our delivery mechanism so that our training and installation business recovered strongly in the second half. But more importantly, it was actually as effective in many cases as it was before. So the absence of being able to get on ground didn't compromise the results we were able to get, but actually it also drove better efficiency because we were less, there's less travel and for our teams and for our supporting consultants, but also we were able to get better efficiencies out of using their time. So there's some really interesting sort of aspects of the operational deliver it. On top of that, and as evidenced by the figures, you can see we had engaged this partial disposal of Open Connect business. Open Connect was a business we bought in 2019 for some very clear technology and a very strong client base in the American healthcare market. But it had a number of portfolio products within it that just don't fit our strategic roadmap. But what was gratifying was we were able to sell that bit for significantly more than we acquired the whole company for. But I think the important thing, aside from that simple financial instrument access, is it was the process of extracting essentially partial, elements of company products out of a sort of the legal entities in the US, which was no mean feat. Let me tell you, because then you overlay that on, oh, and by the way, we also IPO'd. And you can imagine from an internal execution perspective, it's been a very interesting year for the management team and for the whole business because of the loading all that provides. So you aggregate those things, effectively an incredibly successful business year, particularly recovered and given the realities of the audience we're working with, the execution of that Open Connect, and then the IPO, which in itself was an achievement and a really gratifying achievement in the sense of I think it enabled us has really given us that platform for future growth in terms of why we IPO'd. I think that's coming through in spades. So we'll go into more detail now, but in summary, I think it has been quite an amazing year for the business and sets us up very well for the future. On that basis, I will stop talking for a second and Paddy, hand over to you.
Thanks, Richard, and good morning, everybody. So I'm going to take you through the commercial model for the business, but fundamentally, we sell high margin recurring revenue contracts with very low customer churn with a very well established customer blue chip client base, and Richard gave you a flavour of some of the customers we have there. This gives us very good forward visibility of our revenues, and we've got a cost base that's predominantly people that we can flex to meet the market demand and respond to market conditions as we want to. This is supported by a very strong balance sheet, a very simple billing model, and that drives cash ahead of our EBITDA throughout the year. We've got two revenue streams. We've got a SaaS revenue stream, which provides access to our workwear platform where our core products sit. We price this on a per user basis and recognize that revenue over the course of the contract, and we bill it annually in advance. We've also got a training and implementation revenue stream, and that's there to configure the software for the customer and then train the customers on the methodology that we have. It's also priced on a per user basis, but can also be time and materials if the customer is looking for that particular flavor. And we bill that in ideally 3 stages over the course of the implementation. Now, our products, we have two key products: Control IQ, which is a roughly 10 to 12 week implementation program, and Work IQ is about a 3-week implementation program. The training and implementation revenue stream can be a little bit volatile, and that's because of where we install it. If we're installing or training in a high margin or high cost environment, such as the US, that'll be a high margin for us versus, say, in India. Either we may use our coaches to help deliver those implementations, or we could use a partner, or indeed an existing customer might have their own in-house center of excellence, and that would obviously be less revenues for us, and hence a variability in those margins. The customer base we've got is focused on banking, financial services, and health insurance, but as Richard said, large institutions in that space. And our top 10 customers have seen SaaS ARR growth, annual recurring revenue of 17% in the last 12 months. They account for just under 50% of our SaaS revenues, and no single customer has more than 7% of our SaaS revenue base. Pricing is Control IQ is roughly 2 to 3 times that of Work IQ. And we see a clear upgrade path from the Work IQ product to the Control IQ product over the life of the customer. And the Work IQ product we acquired, as Richard mentioned, from the Open Connect acquisition a couple of years ago. And we're also seeing an opportunity for our existing Control IQ customers to add the Work IQ product to their portfolio that we already sell them. So we see that cross-sell opportunity there as well. I'll just move on to our KPIs. I'm not going to dwell on these, but if we look at the annual recurring revenue on the top left there, that's at 18.3 million at the end of the financial year. That's moved forward by 7% from the prior year. And our net revenue retention, so the revenue we get from our install customers, existing customers at the beginning of the year, that's progressed to 104%. Now, that's only marginally lower than the range we've seen in prior years of 105 to 110%. And given the impact of COVID, we're comfortable with that. And then the other one to pick out on this slide is the operating cash conversion, where we see 350%, so cash ahead of our EBITDA by 350% in the year, with very strong cash collections at the end of the year. Now, as you might imagine, we're dealing with big corporates here and big bills as well, so the cash collection can be lumpy, but we certainly have no challenges in terms of that area. I'm just going to move forward to the P&L. So the table obviously looks at the P&L for the year versus the prior year. And as you can see here, we've had 10% SaaS revenue growth over the course of the period in what has been a challenging year for us. And I say challenging year for us, challenging year for the globe, of course, with the pandemic. Training and implementation revenues were hard hit in the first half of the year, and that was a result of obviously the pandemic hit in mid-March, early March time, and our customers, when we were implementing, did pause all the implementations that we had running at that time. Clearly, we obviously had to pause our revenue recognition associated with that, and that led to a low first half of training and implementation revenues. This did pick up strongly in the second half of the year as customers got back to the offices or got comfortable with working from home. And our implementations, as Richard talked about, resumed remotely and very effectively remotely as well. And we've seen a strong improvement in our T&I revenues back to normal levels, what we'd expect in the second half of the year. Margins in the business have been strong. Software margins at around, SaaS margins around 87%, a slight tick up from the prior year. And likewise, the training and implementation margins have also moved up a little bit to 48%. And that's a result of, as I said, that mix of contracts. We had a good mix of high value contracts in the North American region in year-end 21. And the remote implementations have helped in that as well, with lower travel expenses. Our operating costs are predominantly headcount, with the exception of the hosting costs, of course, for the software. We continue to invest in R&D spend and sales and marketing. We have seen a slight drop in the sales and marketing costs, which is predominantly travel, as a result of the pandemic, with our sales teams and delivery teams and customer relationship teams unable to go and see our customers, of course. And we continue to expense R&D and sales commissions through the P&L. So as I said earlier, we've got good visibility of our revenue streams, and that enables us to manage the business to a broadly break-even position, as we've been flagging at the IPO. We do expect ongoing investment in our sales and marketing and research and development in this year and the subsequent year. So we do expect to be loss-making, marginally loss-making, or in those periods as we move forward. As Richard has flagged, we made a good profit on the sale of part of the Open Connect business, retaining the pieces we wanted, which drove profit on sale of 11.8 million from not only the sale, but the discontinued operations. And then there's some exceptional costs, of course, to do with the IPO and some share-based payment costs, which are very small in year-end 21, but will increase as we move forward. The strong operational gearing that we've got in the business model, however, means that we do expect in the medium term to move to a solid, profitable EBITDA position in subsequent years. We've got a very strong balance sheet, as I said. We've moved to a net assets position, positive net assets position in year-end 21 as a result of the sale of the Open Connect business, which did add a significant amount of cash to the balance sheet. And we've got that positive cash conversion as well. So there's significant movements in cash across the year. Obviously, the adjusted EBITDA coming through and the cash from operations. But then that slug of cash coming in from the Open Connect disposal, that enabled us to repay the debt that we had in the business of 7.3 million pounds. That obviously means that the interest charge that you're seeing there will fall away moving forwards. And then as part of the IPO, we had some number of share options that were exercised that generated 1.7 million of cash for the business. And associated with that, there were some employee taxes to pay by the employees or the people who exercised those options of 3.5 million. That cash transitioned through the company across the year end. We IPO'd on the 29th of March, and that cash was paid on to the tax authorities in early April. We do have some brought forward tax losses that we will utilise in subsequent years as we begin to make a profit. And we've got very strong cash in the bank at the end of the year. So with that, I'm going to hand back to Richard, who can talk you through strategy and the outlook for the business.
Thank you, Paddy. Essentially, the message here is as we've said, in the sense that there's no immediate change or plan to adjust the strategy. Our target market remains the same because the organizations we're selling to have some very high costs and they have some clear presenting challenges, whether it's from a service or a compliance or a cost reduction, which makes our product both relevant and particularly focused on that sort of particular business problem. So our target addressable market remains a very large one, and we are seeing a very healthy growth in our pipeline and our new logos in that area. So there's no change to the target and the direction of travel in that respect. In terms of our differentiation, I think I made a lot of this in the initial flow. We fundamentally have two. We have a arguably slightly geeky obsession with the dark arts of the back office. And that is a particular problem set where you have multiple issues around complexity, compliance, staff well-being, and so on. And that is our focus. And I think fairly uniquely in that is our sort of long, 15 years of experience and data and everything else. That is a key and perpetuating source of differentiation. The other dimension, though, is it's the ability to scale that to large organizations. And anyone who will talk for a second about the challenges of deploying both change management technology in large corporations, it's a difficult, hairy problem to address. And ActiveOps has an extraordinary track record of success. In other words, not just good software, but good customer outcomes in this respect. And the length of our relationships with our long-standing customers is a testament to that. So I think that source of differentiation is one that essentially remains and will scale. And then to that end, we will be maintaining our investments in our R&D, our presence on the ground, and to sustain that kind of enterprise scalability that I think is a real differentiation. I think particularly one of the things to call out here is the emergence of this so-called EPM market that Gartner is describing, employee productivity monitoring. The encouraging thing from our point of view of that, Gartner are really sort of starting to build a profile around that segment of the market. But they're also highlighting, as that quote there relates to, is the need for, if you like, more sophistication to those things. It's not a question of simple time tracking. It's actually about how people use that information and how you embed that in how the operating practices of organizations to promote staff well-being and so on. And although we couldn't actually put the defined quote in here because it would cost more than the company turnover probably from Gartner, that they cited ActiveOps as the example of a more sophisticated offering. So it's things like that I think are evidencing our strength to the market. In terms of some specifics, we've creating some regional councils around our client base to develop that kind of subject matter input to drive our R&D. We're doing a lot more with the analyst program, as talked about Gartner, and also notably, and we also released a book this year, myself and my other co-founder, around the particular ideas of the methodology, and that's not everybody's idea of a bedtime read, but it's certainly proved quite relevant and successful. I think on the technology front, one of the things that I'm particularly pleased with is the extent to which our new re-platform Control IQ product is now being deployed, because it's difficult to overestimate the impact of that on our go-forward position. Fundamentally, what we had, as you can imagine, with a sort of 15 years experience, was an evolved product. We've been a SaaS company since 2005. And that's been absolutely fundamental to our business. We've never had an issue with, if you like, moving from on-prem to off-prem. But with the new product, what we've got is a completely state-of-the-art Microsoft SaaS product, which facilitates, in architectural terms, the integration of our product in a much more embedded way within all the other kind of artifacts and structures that in enterprise software. And that impact of Control IQ in terms of the go-forward position is incredibly exciting, because it means essentially our product is even stickier in terms of the infrastructure within it which it places, and is part of the sort of lights-on infrastructure that organizations need to seek to have. I think our Ops Index also, we have this amassing great set of information on transactions, activities, amount of time spent on holiday, work, sickness and absence, and so on through. And we've converted that into this data set now, which our customers use in terms of the Ops Index. And that, for the first time, provides an indexed basis for judging how good are operations vis-a-vis either peers, competitors, suppliers. So we have examples of our so for example, our banking customers and an outsourcer using the Ops Index as a reference point for how to maintain the level of quality of service, which is a huge addition to the traditional sort of just pay for a headcount and we'll monitor sort of service outcomes. So I think the potential for the expanded use of Ops Index is growing all the time. It's worth talking about the customer base. A strength of our sales technique has always been the land and expand. So in other words, we will secure new logos relating to a particular business issue, which commonly is in an area of a business, And then with the experience of the value of that consistent control that our product brings, it's essentially applicable across a wider estate. And that's been the hallmark of ActiveOps through its whole 15 years of successful activity. And I think what's great is even in the context of recent, that has continued. So we are expanding, and Paddy quoted already, we have 17% growth in our top 10 customers, which again is just an underlying indicator of that. The US particularly has grown incredibly strongly last year. And then with the addition of the WorkIQ product, which is the employee productivity monitoring software, that's opening up a whole new level of opportunities, not only for new customers, because it goes beyond the heartland of the back office to a more general base of employees within organizations, but it also offers cross-selling. And just to give you one example, one of our largest American customers for the traditional workwear product in the ActiveOps portfolio is now deploying the new WorkIQ product across their estate. And what's very encouraging is the extent to which the two things are, for them from an ops control perspective, are definitely delivering a 2 + 2 = 5 in terms of the value that they're able to get from both sides of those products and the information and the quality of control that brings. So our cross-sell, upsell activity is I think very encouraging, let's put it that way. I think I shouldn't, however, go on without commenting on the business selling context. We are selling large enterprise software, and one of the consequences of COVID is sales teams and relationships are difficult, more harder to build. So there is definitely impact on the pace and progression of pipeline. I think it's probably in a sense a new reality. Deals are there and they do progress, but the actual time to do them is we're seeing it takes longer for them to come to fruition, and I think that's as much to do with the internal challenges in our client side organizations for resolving and defining things. I mean, just for example, we've had customers that have definitively said, our return to work strategy is going to be X. We're going to have everybody back in the office within the next, month or so. And then within the next, 2 weeks later, they've completely done a 180-degree turn and said they're not. So if you can imagine, in terms of specifying and requiring and consolidating large company requirements to build a requirement like ActiveOps that might provide, that is more challenging than it's been before. So I think the quality of the pipeline is as strong as ever. We've got 24, I think, new logos in the immediate sort of pipeline book. When you think that we sold 12 last year, and so there's the pipeline itself is strong because the business needs are coming clearer. It's just the practical aspects of selling that has been a challenge. Just to touch briefly on ESG. The great thing about ActiveOps has always been, if you like, our fundamental proposition is one of we believe passionately in a safe, controlled environment is good for the well-being staff, and fundamentally providing control is not only good for customers, but the biggest cause of stress at work is uncertainty. So by creating an environment where people are not, if you like, running around reactively to work pressures is simply a healthier environment. So our fundamentals have always been very strong. But in line with, I think, the experience of going public, what we're looking to do now is starting to report in a more structured fashion against some of the established reporting frameworks, so that by this time next year, I'm confident that we'll be able to report in a more articulate way on our ESG activities, whether it's from environmental impact or indeed some of the things that we've already been doing and we are doing in terms of charitable and social responsibility type activities. I think this is a really nice example of things where the very act of becoming public has enabled us to think more carefully and also expose more structured way the things that we are doing. So just to sort of summarize on that, the basic message here is we are executing our strategy, and our strategy is what we've defined from before the IPO and continue. We're accelerating our development capacity. We are exploiting and making sure we're top of the pick in terms of the growing EPM market, and in line with our fundamentals of a SaaS business is recurring revenue, is continuing to invest and deepen and expand our sales and our relationships and the embeddedness of our products with our customers, which means we invest in our sales and our relationship management teams. And that's the reason behind, as Paddy suggested, we continue to manage our costs very carefully, but fundamentally we think the growth is there to support that we can convert in the next 3 to 4 years. But in the short term, we think that level of investment warrants the sort of negative EBIT for the next year or so. Moving on then to the first quarter, it is very encouraging. It's nice that the market context is saying we need better control, we need better precision, we need better exposure to make sure our staff are working the wellness agenda. These are all drivers to support interest in our products. So essentially, the trading in the first quarter has been in line with our expectations. And in terms of the specific mechanics, we've got 2 new customers, 2 in this current year. We've expanded in on 13 accounts, and our investment and product plans are progressing. So I don't think there's anything to say it's anything other than on plan. I'm not saying it's anything beyond the plan. I'm saying it's very comfortable. It's within the range of our expectation. And very happy to take questions.
And we've got a question from Kieran Donnelly at Liberum.
Well, firstly, congratulations on a great set of results. They're very impressive stuff given the environment. I guess it would be great to kind of get some more context just in terms of the growth you saw in the year. I think you said 12 new customers, but just a breakdown of where the growth came from in terms of new business wins versus expanding into kind of current customers, and what's the shape of that going to look like going forward?
So it was reasonably well. It was encouraging. I mean, we had, I think, 11 new customers, which compares with 12 the previous years. So I think the overall balance of new versus old is actually continuing that trend. And bear in mind, historically, when you look at our growth, securing that number of new customers each year has historically given us a very good footprint for the subsequent 2, 3, 4, 5 year sort of expansion activity. So I didn't, in overall terms, I wouldn't say we saw a great shift in the balance between the old and the new and expand. What is interesting though is, I mean, clearly the US, and on the back of both the acquisition and the product range, I'm particularly pleased with the progress in the US. I'll call out one customer, Anthem, which is Anthem Healthcare. They had a small footprint of the so-called WorkIQ product, and that went from sort of 2,500 licenses to about 21,000 licenses in a period of time. Wasn't exactly within that calendar year, but that's the sort of scale of opportunity. Other expansion customers are people like TD Bank, who and they did quite a good case study recently on their impact of having ActiveOps in the COVID client context. But we first came onto us. We first had a customer, them as customer in 2010. And today they're expanding strongly. So I think, Kieran, the headline is it's across a broad spectrum. So even our, Westpac, National Australia Bank, and ANZ, they've been developing and testing the expansion of our tool set. So there's growth in what are, at the end of the day, a very well established, long-standing customer base. In the UK, one of the major retail banks you know the name of, they again have expanded sort of like 200% over the year. So there's the encouraging thing. I think that the US is really quite clear the big story if we can really grow and expand that, and that has made some really good progress from what is essentially quite a low base. But equally, the other markets themselves are certainly proving to be solid, I think is probably the best way of putting it.
And we have another question from Alistair Young from Panmure Gordon.
Hi, thanks very much for the presentation. Again, congrats on the great start to life as a public company. Just one quick one for me on your net retention rates. I wonder if you could possibly give us a steer on the mix of upsell versus churn in that. And then secondly, whether or not within that upsell number, you can perhaps comment on the sort of mix of sort of just new users, new seats for the same product versus sort of perhaps adding new products to or within a given customer. Thanks very much.
I asked great detailed questions there, and you're making my head hurt as I think about it. So I think the balance between churn and growth it's ongoing. I mean, there's some interesting dynamics in our product because we drive efficiency, and efficiency, aka people can convert capacity in a number of ways, going off and doing different things, but equally they can reduce the people doing it, reduce the heads doing it. So there's a kind of inherent dynamic. If we achieve a 15% productivity gain, which is classically what introduction of ActiveOps does, implicitly, therefore, that might in itself have a natural churn in the context of the addressable community that we're doing. In practice, it very rarely happens like that because people have, they've got overtime, they've got backlogs, they've got things that then requires sort of more time and attention, which usually the same people go off and then do. So there's a kind of interesting dynamic there in terms of that. But then you come to people who are actually I mean, for example, one of our customers this year outsourced a significant chunk of their business to a third party who aren't ActiveOps users. They may well be because they've gone somewhere and that opens up another opportunity. But that represents a chunk of capacity that now goes to somebody else. So we have, you see, that kind of underlying dynamic in our churn. And what was last year like? Again, it's distressingly normal in that sense. There is always churn events, people strategically executing their strategies in different forms, some which we either accelerate in some cases, and in some cases it doesn't affect. It does impact on our revenues. On the other hand, the expansion growth, I think, was good as well. So netting that, I mean, as Paddy alluded to, 104% net revenue retention is historically at the lower end of our scale. Normally, we would expect it somewhere in the 105 to 110, 12 maybe, going back. So there's some, that I think is a slight guide to more the sort of chaos and confusion of the past year. In terms of the new product, the interesting thing there is, again, you've got growth in existing customers. So if we reckon we get about 14% of a typical bank's general work from our core product, in other words, it's addressable about 14% of the labour force. But with the Work IQ product, that transforms that to sort of probably double, if not triple that, because essentially it's time measurement. And particularly the TD expansion, the Anthem one, is giving us opportunity, I think, to see some expansion of the customer base to effectively an audience we wouldn't do. That's a bit of a cross example, different examples, and I perhaps could pick up better data to provide you with a different occasion. Paddy, I don't know if there's any particular points in relation to that.
Yeah. Thanks. Yeah, and Alistair, the only thing I'd add to that is that our customer churn is very, very low. Once customers join us, they tend to stay with us, and we've got customers who've been with us 15 plus years or so in a number of regions, or in all our regions. So the dynamics Richard's explained there are absolutely right, and year-end 21's been in line with other years, and just to reinforce the point that our customer churn is low.
And a written question now. Across your 10 customers, how deeply penetrated are you, and how much more growth opportunity do you see within them? Do they all have both Work IQ and Control IQ, and are both offerings applicable to all customers?
So we did some research specifically leading up to the IPO, where we looked at our top 20 customers, and if you like, how much of their addressable community, that's customers, their staff, if you like, that would have sort of relevance for our type of product. And we came up with a number of 70 million worth of exploitable ARR in that customer group. So we do know there's an awfully large opportunity. And that's, so for example, we have a customer as an outsourcer where we've got one particular portfolio account, and at the end of the day, they are a worldwide BPO, and as such, potentially we have got the case studies therefore to springboard into that. It doesn't make it necessarily a walk in the park, indeed, if only with us, but we have got there's a very large addressable community, addressable market within our existing customer base. The cross-sell, upsell, again, I think that's changing. I mean, I've spoken already about the Work IQ. The other way around is also interesting. So if you take Anthem, which is one of the marquee Work IQ products, they are very much interested in how they now use that data to expand planning, which takes them back into the Control IQ product. That's an area which I think we would say has not progressed because of the chaos of last year in quite the same way. You can imagine what we want to do is land some pilots and get some experience, and it's just one more thing in the context of some of the current challenges, which is harder. So we've got plenty of, if you like, interest in that. It's just the execution. So I think there's one of the strengths of the business is that, as if you like, companies with whom we have a commercial contract already and whom do have larger expansion opportunities.
Thank you. And that's the end of questions. Richard, do you have any closing remarks?
Only briefly to say, obviously, thank you for taking the time to do this. It is a kind of new experience for us, and we were pleased with the outcome of the IPO. I think these results are hopefully entirely in line with with both what we promised and set expectations around. And I think that is the message going forward. This is a enterprise software business, which is selling to complex large organizations. The benefit of being a public company is coming through in terms of some of the sort of mechanics of contracting, the credibility we attract. And I am excited about the impact that will have on the process. Same time in the business, the business outlook in a general sense is very good for us because the context of the need for better control is is clearly come through very strongly. At the same time, and the other message I've obviously been giving is just the practicalities of working and selling in the current environment is not getting any easier. So you've got those two sort of things, which overall leads me in a place that says, we are incredibly confident about the outlook we have, and we're excited about the progress the company can make in the next few years.